Is now a good time to look at refinancing your mortgage? We'll go through the pros and cons so you can make an informed decision. Hi everyone, Chris Egan, Berkshire Hathaway Home Services here. I've had a lot of questions from clients recently asking about refinancing and if now's a good time to do that. So I thought I'd put together a quick video and we'll go through some of the pros and cons so you can make an informed decision. I'm recording this September of 2019. Rates right now are hovering right around 3.75%. Just to give you some perspective, last year at this time, they were about 4.5%. So it does make sense in some instances to refinance, even if you've only had your mortgage as little as a year. So some of the obvious benefits and drawbacks to refinancing. We'll go through the drawbacks first. There are, of course, the upfront costs of refinancing. You will again have to pay a loan origination fee, usually a doc fee, and then you'll also have title insurance and an escrow closing fee. Those are what are involved in the closing costs of the mortgage. You will again also have to pay your homeowner's insurance from the time of closing going forward, and then also fund your escrow account, similarly to what you did when you purchased your home. However, you will get that money back when your old mortgage closes. So those are the upfront costs, which are typically a hindrance in refinancing, but you can recoup some of that. And the general rule of thumb is if you can recoup that upfront cost within the first 2 years of the refinance. So if you ended up saving $200 a month and it only cost you $2,000 to do the refinance, typically, as far as a rule of thumb, that's usually a good time to refinance. So the two main benefits of refinancing your mortgage are, one, you can reduce the amount of interest you pay. And then two, when you do refinance, you can manipulate the term of the loan. So you may be able to refinance to a 15-year mortgage or maybe stretch it back out to a 30-year mortgage so you can have a reduction in payments if that helps your monthly cash flow situation. So that's something you can look at doing when you do the refinance. Of course, you would never want to refinance strictly to reduce the term of the loan because you could just pay extra to do that. But if you're going to be refinancing to a lower rate anyways, it might make sense to reduce the term. Or some people also will extend the term so they have a lower monthly payment because they have other cash flow obligations. So I thought we'd run through an example of an actual client of mine who just completed their refinance, and we'll go over the numbers and you can see how it benefited them. In their particular instance, it was extremely beneficial for them to refinance because when they purchased their home, they used an FHA mortgage. And there's nothing wrong with an FHA mortgage. They're totally fine. But in their case, they did have the mortgage insurance premium, which I'll get into a little deeper here in a second, but they were able to eliminate that at the time of the refinance. So this couple purchased their home with me back in December of 2016. And at the time they paid $192,000 for the home and they got a $188,000 FHA mortgage to purchase it. And that was at 4.5%. locked for 30 years. So they had a principal, interest, and mortgage insurance premium monthly. Those three things totaled $1,031 a month. Now, they did, of course, have taxes and insurance in their payment as part of their escrows, but I'm going to set that aside for a second so we can just deal with the principal, interest, and then the mortgage insurance premium, which was the $1,031 a month. Now, the reason that the FHA mortgage comes into play and why it was more advantageous for them to refinance now is because in 2014, FHA changed their guidelines and any mortgage originated after January of 2014 would carry the mortgage insurance premium for the full term of the loan, so the full 30 years, on any mortgages that were originated with less than 10% down payment. So this couple put the minimum 3.5% down payment down on the mortgage, which then they would carry that mortgage insurance for the whole 30-year term. That was $78 a month. So of that $1,031 a month, $78 of that is just the mortgage insurance premium, which is essentially just covers the bank in the event that they default. So it doesn't do anything for them. So at 3.5% for 30 years, their new mortgage payment was going to be $794 a month. thus saving them $237 a month. Now, granted, they did add an additional 5 years to their term, but they were only expecting to be in the home for another 5 years, so they didn't think they would end up paying off the mortgage in full anyways. So that's the route they decided to go. Their other option that they were considering is they could have gone to a 20-year mortgage, reducing their current term by 5 years, and that payment was $1,029 a month. So it only saved them $2, which isn't too significant, but they would have taken 5 years off of their term. They decided to go with the 30-year mortgage because they had some other goals that they wanted to do with their monthly savings, and it ended up costing them $1,950 was the total cost and to refinance. They're going to be able to recoup that pretty quickly. So I just wanted to give that example and that scenario. Of course, everyone's situation is different, and we just want to be your resource. So if you have questions, comments, concerns, of course, feel free to reach out to us anytime. And we're going to try to make some more of these videos going forward to keep you informed about the real estate market and stay in touch with you.